Most investors think monthly income is about chasing biggest yields. They see double-digit percentage and get stars in their eyes, and hit buy button without thinking. They scroll through a screener, pick the highest number on the list, and hope for the best. But here's the problem. Sky-high yields are usually a red flag. The market is often telling you that the dividend might be at risk, or that companies' fundamentals are quietly deteriorating. True monthly income investing is not about who pays the most today. It's about durability, cash flow, and sustainability. It's about owning businesses and funds that can pay month after month through bull markets, bear markets, and everything in between, without you checking your account every hour. Today, we're breaking down 7 ETFs and stocks that pay monthly income. These are ranked from the weakest to strongest. And remember, weakest on this list is still a quality option. Ranking are based on dividend stability, long-term growth potential, and risk management. These are not hype-driven picks. These are designed to generate cash for years, not just months. If you want income you can actually rely on and wealth that grows over time, hit like, subscribe, and let's dive in. Starting at number 7 is the riskiest name on our list, Peyto Exploration and Development. Peyto is one of Canada's low-cost natural gas producers. In commodities, being low-cost leader matters. Their efficiency allows them to maintain a high monthly dividend even when the other producers struggle. Right now, Peyto yields around 5.5%, paid monthly at 11 cents per share. They returned to a monthly payout in 2021 and have stayed disciplined since. A big confidence booster is their balance sheet. Peyto refinanced $100 million debt at roughly 5%, showing lenders still trust the business even in a high interest rate environment. Operationally, they benefit from owning much of their own infrastructure, including pipelines and processing plants, which helps keep costs predictable. Now, before you treat this like a guaranteed paycheck, let's talk about where the cracks could show up. Peyto is directly tied to natural gas prices. If AECO prices fall or pipeline bottlenecks reappear, dividend safety shrinks fast. This is a high-risk, high-reward income play. It can deliver heavy cash flow when the prices cooperate, but it is not bulletproof. That volatility is exactly why it sits at number 7. Number 6 is RioCan, Canada's largest retail REIT. The word retail scares a lot of investors, but RioCan today is very different from the old mall model. They own high-quality properties in major Canadian cities with heavy focus on grocery stores, pharmacies, and liquor stores. These are places people visit regardless of economic conditions. RioCan currently yields about 5.9%. After resetting the dividend during the pandemic, growth has returned, averaging roughly 4% annually. Their long-term strategy is mixed-use development. They build residential units on top of retail locations, unlocking extra value from land they already own. That said, every REIT has pressure points, and this one is no exception. The Canadian consumer remains under stress. Higher unemployment or weaker discretionary spending can hurt smaller tenants. On top of that, elevated interest rates make large development projects more expensive. RioCan is a strong income producer, but it is closely tied to the health of urban consumers. Number 5 on our list is our first ETF. XCI is a classic solution for investors who want monthly income without single stock risk. It holds more than 75 dividend-paying Canadian companies, including banks, utilities, telecoms, and energy producers. The yield sits around 4%, paid monthly, with dividend growth averaging about 7% annually over the past 3 years. 14 years of uninterrupted monthly payouts make this a true set-it-and-forget-it holding. Diversification adds stability, but it also introduces different kind of risk. XEI has heavy sector concentration. Roughly 30% of the fund is tied to energy, which means the share price can swing when oil prices move. It is a solid foundation for income, but it does not strictly filter for balance sheet quality, which keeps it firmly in the middle of the list. XDiv is best described as the smarter sibling of XEI. Instead of buying everything with a high yield, it screens for companies with strong balance sheets, low debt, and consistent earning growth. The yield is slightly lower at around 3.75%, but dividend growth has averaged roughly 12% annually over the past 3 years. The fund focuses on banks, utilities, and insurers while actively avoiding common yield traps. Quality improves reliability, but concentration still matters. XDiv is heavily exposed to financials. A major banking crisis could impact the fund more than a broader ETF. Still, for investors prioritizing stability and long-term dividend growth, XDiv is one of the best monthly income ETFs available. At number 3 is Exchange Income Corporation, a company many investors overlook. EIF owns a collection of niche businesses, including regional airlines in northern Canada and specialized manufacturing companies. These are essential services with very little competition. EIF has paid a monthly dividend for 21 years, never missing a payment during the 2008 financial crisis or the 2022 lockdowns. The current yield is about 2.8%, lower mainly because the stock performed well in 2025. The dividend itself has increased 18 times since 2004. Management focuses heavily on free cash flow, not accounting earnings. That discipline is what makes the dividend so reliable. Still, this business model is not without risk. EIF grows primarily through acquisitions. That means management must continue finding high-quality companies to buy at reasonable prices. If acquisition opportunities dry up or are poorly executed, growth could slow. Even so, the track record here is hard to ignore. The runner-up is Granite REIT. While RioCan focuses on retail, Granite owns industrial warehouses and logistic hubs that power modern economy. Their largest tenant is Amazon. Granite yields about 4% and has delivered 13 straight years of dividend growth. Triple net leases push property taxes, insurance, and maintenance costs onto tenants, creating highly predictable cash flow. Their business sheet is among the strongest in the REIT sector, with low leverage and conservative financing. The main concerns investors raise with Granite is interest rates. Higher rates can pressure REIT valuations in the short term, but demand for industrial space remains extremely strong, allowing rents to rise consistently. For investors serious about depending on monthly income backed by essential infrastructure, Granite is a core holding. The top spot goes to Severia, and yes, the yield is only about 2.2%. So why is it number one? Because it combines monthly income and long-term growth better than anything else on this list. Severia is a global leader in accessibility equipment, including stairlifts, home elevators, and wheelchair-accessible vehicles. This is not a trend, it's a demographic certainty. Aging populations across North America and Europe guarantee rising demand. Dividend growth has historically averaged around 10% annually. That means a modest starting yield can turn into a powerful income stream over time. High barriers to entry, strict safety regulations, and global scale give Severia pricing power. With a strong balance sheet and expanding international footprint, the stock delivers a monthly paycheck that keeps getting bigger. And that is why it earns number one spot. Monthly income investing is not about finding the perfect stock. It's about balance. The goal is balancing yield, safety, and growth. If you found this breakdown helpful, hit like and subscribe for more videos on Canadian investing. Let me know in the comments which of these do you own, or which ones you are watching heading into 2026. Because at the end of the day, boring, reliable income done right is how real wealth is built. Thanks for watching, and I'll see you in the next one.